Imagine paying $1 million, not for a house, not for a land, but for a flower. In 1637, a single tulip bulb sold for more than the average person earned in a lifetime. This isn't folklore. This isn't a meme. It was the world's first recorded financial bubble. And what it reveals about human behavior, risk, and derivatives still echoes in the modern markets today. From tulips to Tesla, bubbles all smell the same. 1600s Amsterdam, the richest, most advanced city on earth. Dutch traders were the kings of commerce. They mapped the seas, banked across Europe, and even invented the stock exchange. Into this world of wealth and ambition came the tulip. Imported from the Ottoman Empire, rare, fragile, and utterly hypnotic, the most prized varieties didn't look natural. They had vivid, flame-like streaks. These were broken tulips, infected by a virus that distorted their color. Ironically, the flowers that were biologically sick became the most valuable. These weren't just plants. They became status symbols, the Rolex of the garden. And at first, the buyers were wealthy collectors, then aristocrats, then merchants, then everyone. At the height of the mania, a single tulip bulb, like the Semper Augustus, could sell for the price of a luxury mansion on the Amsterdam Canal. But here is the twist. Most buyers never touched a tulip. They were trading contracts, agreements to buy or sell bulbs in the future, sometimes months ahead. These were futures contracts, the same tools we use today in oil, wheat, and Bitcoin. No money changed hands up front. No flowers were exchanged. Just promises. And that made it easy to leverage, to bet big without having any cash. The tulip market became a market of speculative IOUs. And as long as prices went up, everyone was happy. But beneath this beauty, a fragile web of debt, delay, and belief was forming. Here is how it worked. You agree to buy a bulb in March for 100 guilders. In February, someone offers you 120 for that same bulb. You sell the contract, not the flower. You pocket the 20 guilder profit, even though the flower hasn't bloomed. It was a game of pass the parcel, but the parcel was a promise. This chain only worked as long as prices rose. But what if one buyer couldn't pay? The whole chain snapped. This wasn't just a market. It was a Jenga tower made of paper. And when it fell hard. If this sounds familiar, it should. Mortgage-backed securities in 2008, Terra in 2022, Archegos in 2021, all were built on leverage and confidence. Once trust breaks, it is not just flowers that die. February 1637, a bulb auction begins in Haarlem. One buyer doesn't show. Panic spreads. In a matter of days, prices collapse. Sellers outnumber buyers 100 to 1. Everyone tries to cash out, but no one wants to buy tulips anymore. Some bulbs drop from 1,200 guilders to 10. Wealth evaporates overnight. Contracts not enforced by the courts. Everyone just walked away. It was a full system crash. One historian put it simply. The wine had been sold, and now the wine was gone. Tulip Mania wasn't just about plants. It was about us. People believed prices would rise, simply because they had. We call this anchoring bias. We overvalue what's familiar, availability bias, and we follow the crowd, herd mentality. Or in modern terms, FOMO, fear of missing out. Bubbles don't form because we are dumb. They form because we are too human, because we crave the high of winning and forget the risk of falling. Fast forward for 100 years, Today's markets have algorithms, models, and risk systems. But the same story plays out, just faster. That's where acronyms like cross-VA, CVA, FVA, MVA come in. What tulip traders ignored, modern quants obsess over. CVA, what if the counterparty doesn't pay? FVA, what's the cost of borrowing to fund the trade? MVA, how much margin should we post? KVA, how much capital is at risk? These adjustments try to quantify fragility. They are the modern math that protects us from ancient mistakes, or tries to. Because even with models, people still chase the next big thing. Just ask people who bought Luna at $80, or the banks that ignored Archegos leverage, or the traders who said, it's different this time. Spoiler, it's never different. One tulip once cost a fortune. Then it taught a lesson. That value is only real when it's understood. That risk is invisible when ignored. And that when you price dreams instead of fundamentals, you don't build wealth. You build a bonfire. If you want to learn how bubbles form, how risk hides, and how math tries to fight emotion, subscribe. Because this isn't just a story about tulips, it is a story about us.